a silver market is very, very helpful in helping us to discern this massive divergence in between the paper and the physical disconnect in gold and silver. So we use silver as an illustration of how the all watched, for example, the COT report, for example, which a lot of people will look at, and it's a primary tool that people use, and it's also used by insiders to wrong foot all the non-insiders, so, you know, the punters in the casino, basically. And what it is that outside of this casino, anyone that's operating in this casino, for the most part, has no visibility into what we're trying to provide you here is an insight into the wholesale side of the market. And so what we're seeing is, and we kind of talked about this a little bit last time, what we're seeing is the market making insiders, i.e. the house, who are visibly logging short positions. Now, when we go on to the COT report, and the delayed COT report was just published on Monday, and it shows a massive amount of short interest coming in, i.e. people betting against gold, or what appears to be them betting against gold and silver. And then really, but what this silver market is telling us, what it is telegraphing, because it's a smaller market, we can actually, and because we know the participants are so much more visible, what we find is that these same insiders that are logging positions that look to be short, they're actually hiding, they're offsetting short positions with unreported long positions in the spot related physical markets. And we see them, this is the point, we see them active in the physical market. Then you look at the COMEX and you see, well, hang on a minute, why is all this short interest appearing? Now, that wrong foots a lot of people. It's designed to do so. So the example that we're talking about became evident based upon the absolute certainty that spot silver, liquidity provider, and COMEX market maker, we talked about them last time, Standard Chartered, Indian Bank, but a market maker on the COMEX, were aggressively chasing every single ounce of global wholesale silver supply, and it commenced on the exact day and at the exact same times to the tick, I mean to the second, where we saw a free fall of short positions coming into the market. Now, that was on November, if you go back to your charts, have a look, I mean, that was when the lows were made. And that was on November the 2nd and 3rd, and the low was made at 23.045. That's about $2 lower than while we're recording this on Tuesday the 16th of November. Now, look, it's really rare to get such a clear intraday window into this smoke and mirrors world of this COMEX, of where the COMEX insider footprints are evident. And what it does is give us a window into these same actors' footprints in gold futures. And as is the case, these deliberately hidden footprints were exposed directly as our suppliers were reporting live these unprecedented large forward purchases as they unfolded real time. And as we discussed last time, during this mega physical buying process, this is unprecedented since March 2020, basically. We've not evidenced that since then. And all the blinkered COMEX century traders saw from their side of what they corralled in this house was the related short COMEX positions coming in, unrealizing that they were hedged, tricking these wrong-footed speculators into momentum selling their silver into the insiders' hands. Look, if you're going to see tons of sell orders coming in and you see the price cascading down, you know what? Unless you are an insider or a stacker, if you're playing the paper game, you will dump those positions. And that's exactly, you ignite the free fall that enables you to do that. Now, it wasn't just Standard Chartered locking in 2022 forward production. No, I'm not saying 21, 2022 forward production. We've also received reliable reports that every single market-making bullion bank with a view into the tight wholesale market has moved in to mop up every single available ounce, not actually contractually locked down, i.e. if we've agreed at the beginning of the year to buy a minimum or a maximum amount, unless we've actually bought that. Now they've removed the option of actually taking what we had guaranteed we would take. So anything above that is gone. Now, in fact, buying in the tight wholesale silver market was so aggressive and continues to be so that Standard Chartered were offering record large premiums over spot to front run all supply, and that was not already, as I say, contractually locked down. And then once there was nothing left that was not previously locked down, this COMEX-centric market-making bank paid very large premiums to buy forward production and to also front-run physical supply deep into 2022. Now, what's not filtered through to the non-insider paper silver market participants is that this vacuum in supply will leave global refiners struggling to provide silver to the general public and the general market in 2022. And this supply deficit will drive the bid price to buy physical silver high enough to attract a seller. That's how a market works. With the retail price once again soaring. And if you remember, we had that arbitrage process kick in March, April of 2020. We're going to see the same thing again. We're going to see the coins and the smaller bars starting to rise in price. And that's a kind of a bottom-up effect, and that in turn will drive wholesale prices significantly higher. Now, given next week's COMEX options structure still does not reflect this paper to physical pricing imbalance, not as of this morning, we view the current enormously discounted prices through the same lens as every single COMEX market market and spot silver liquidity provider and market maker, grossly underpriced and coiled for a much larger move. And that's what they're positioning for. So the current options imbalance reflects some very large offside bearish bets, probably many of those made a year ago or many months ago, into an inflection point not experienced since pretty much April 2020. And if we draw a wholesale market comparison, silver was trading $11 lower at around 13.9 just before silver launched into a 4-month physically driven $16 rally into $30.90. Just like back then, we expect, some volatility, which we saw then, but there's very little spec liquidity, open interest to rinse out. So dips will be shallow and extremely buyable. Now we're seeing this again today. We're seeing some gaming, but it's just to do with options. And as we summed up last time, momentum-driven spec silver futures sellers, along with tricked-in spec short sellers, they don't see that the largest silver buying against the tightest silver shortages evidenced since March 2020 are actually upon us now. And the short-term volatility we're experiencing is the specs reacting to the blinker view that of just one side of the transaction, namely that the short sold gold hedge positions being added from the likes of Standard Chartered and others who are sneakily going along spot and physical over-the-counter silver positions. This is driving the paper physical disconnect to extremes. And as said, I have to draw attention because this is not seen since March 2020. And this is a massive opportunity to buy silver before this wrong-footed, capped, coiled paper market closes the 2012 gap, which is a $10 gap higher into the 35s. And really, everyone we speak to is looking at that gap to close. And this easier to read insight into the insider's footprints in the silver markets reveals what they're also doing in the deliberately opaque gold market, which is harder to read, same actors. Therefore, when we look at this COT report and look at the one that was just released on Monday, look at all the massive amounts of short interest that came in. You have to factor in what we're also seeing in the physical gold markets, which are in massive central bank sovereign and insider accumulation. Now, please bear in mind, when reading this report, the published net short interest that deliberately force out the speculators represents just that one side of the transaction, and that these gold futures shorts also are once-to-one hedged in the unregulated, opaque spot over-the-counter markets. And this makes an absolute farce of the report, especially when insiders plan their largest weekly moves to take advantage of a 3-day blind window between the Tuesday and the close of business on Friday in a picosecond world. This is ludicrous. But by the time this report is published, it is so grossly out of date, while insiders have easily publishable withheld data daily. They are seeing this data today. Now, what the report does do is provide us a view into how the casino uses these purposely disseminated data to wrong foot as many participants as possible, while we balance it up against how the house market makers are positioning in the real wholesale markets.